In today's video, we'll delve into the US Federal Reserve's decision on interest rates, look into the headwinds weighing on the crypto market, and the broader implications of legal challenges and regulatory changes. Also, we'll take a look at the emerging issues as well as unprecedented opportunities occurring now in Bitcoin mining. Let's dive into the latest trends in the crypto market with GoMining. In the latest monetary policy move, the US Federal Reserve has decided to keep its benchmark interest rate unchanged at 5.25% to 5.5%. Jerome Powell, the Federal Reserve Chairman, hinted that further rate hikes might not be on the table for the next meeting. This decision is a neutral development for the crypto market, as keeping rates unchanged maintains the status quo, which can be seen as potentially less stimulating for investment in risk assets like cryptocurrencies. In contrast, a rate cut would likely be much more beneficial for crypto, potentially sparking an influx of liquidity due to reduced borrowing costs, prompting investors to seek higher returns generally offered by digital assets compared to cash-like investments. Moreover, options like Bitcoin would seem like smart moves to protect cash from devaluation. However, in the near future, such a decision to cut rates by the Fed is unlikely due to the challenging economic conditions that require a hawkish stance by the regulator. Over the past week, Bitcoin has experienced about a 7% decline in value, fluctuating within a range of $56,000 to $64,000. This decrease moves Bitcoin further away from its all-time high of $73,737, which was reached approximately 2 months ago on March 14th of 2024, now sitting about 20.6% below that peak. The cryptocurrency sector is facing headwinds from broader stock market sell-offs and a strengthening US dollar index, impacting asset prices including Bitcoin. Bitcoin might also be under pressure from market participants' fears about the slowdown in the pace of key rate cuts. However, the original cryptocurrency's decline to the $57,000 level is more indicative of a local correction than the start of a bearish phase. Supporting this view, Glassnode's latest report suggests that Bitcoin is forming a local bottom, indicating that such corrections are typical and expected market behaviors at this stage. According to their metrics, the net unrealized profit loss, or NUPL, remains in the euphoria phase, highlighting a significant phase of profit realization that has not deterred the bullish sentiment completely despite the recent corrections. The report pinpoints that the NUPL value breached 0.5 approximately 6.5 months before the expected halving event, underscoring the impact of the US spot ETFs in fostering a bullish environment by introducing robust demand into the market. Additionally, the report introduces the concept of navigating local bottoms during market contractions, focusing on the cost basis of short-term holders. Glassnode's breakdown shows that the 1 week to 1 month cohort, with their cost basis around 66.7 thousand, significantly contributes to the price sensitivity during downturns. As Bitcoin approached these levels, the MVRV, or market value to realized value ratio, for this cohort typically dipped into the 0.9 to 1 range, indicating that prices were falling close to or just below the short-term holders' entry points, often leading to a slowdown in selling as market participants await clearer signals for recovery or further decline. Furthermore, the recent Van Eck report highlights a notable decrease in the correlation between Bitcoin and the Nasdaq, a trend that has become more pronounced in recent years. As shown in the graph, the correlation peaked around mid-2021 with a value close to 0.5, indicating a moderate positive relationship between Bitcoin and Nasdaq performance. However, by April of 2024, this correlation has sharply declined to just above negative 0.1. Illustrating a significant divergence in the behavior of Bitcoin compared to traditional tech stocks. The founder of Binance, CZ, has been sentenced to 4 months in prison, a development that has stirred mixed reactions within the cryptocurrency community. Prosecutors originally sought a 3-year sentence, but the judge decided on a shorter term due to the lack of evidence that Zhao was directly informed about illegal activities taking place at Binance. Crypto market participants expressed different opinions regarding Zhao's sentence. In spite of some arguing that this is justified, others emphasized that the case was unprecedented, as it was the first time time an executive faced prison for these specific charges without other accusations involved, especially in contrast to BNB Paribas and UBS, which were heavily fined for similar compliance issues, yet saw no criminal charges against their CEOs. Among notable regulatory developments, U.S. Senator Cynthia Lummis has voiced strong objections against the Department of Justice's stance on crypto self-custody, arguing that it conflicts with existing Treasury guidelines and undermines the rules of law, highlighting the Biden administration's efforts to criminalize certain activities within the Bitcoin network and decentralized finance. Lummis stands in opposition. The cryptocurrency community has rallied against these interpretations, contending they contradict FinCEN's established guidelines as by the DOJ's logic. Essentially, all cryptocurrency wallets and smart contracts involved unlicensed money transmission. Despite a significant decline in revenues following the Bitcoin halving event in April, Bitcoin miners have not shown signs of capitulation. According to CryptoQuant CEO Kai-Young Ju highlighted that Bitcoin miner revenue has reached a 14-month low, yet there is no evidence that miners are giving up. Instead, they face a choice between capitulating or holding out for a potential increase in Bitcoin prices to cover operational costs. This resilience is underscored by the 365-day Pule multiple chart, which indicates that the sell pressure from miners remains low for now. Despite the post-halving profit squeeze and ongoing price corrections, the Bitcoin mining community appears to be weathering the storm without resorting to mass sell-offs of their mined Bitcoins. In a related development that highlights the rewards of persistence in the mining sector, a solo Bitcoin miner succeeded in solving a block by themselves, claiming the entire 3.125 Bitcoin reward. This rare event showcases the potential high rewards waiting behind hard times. Moreover, there have been legislative developments geared towards supporting such resilience in the mining industry. U.S. Congressmen Drew Ferguson and Willie Nickel have introduced a bipartisan bill, the Providing Tax Clarity for Digital Assets Act, which aims to amend tax regulations for cryptocurrencies, suggesting that block rewards should only be taxed when they are sold or spent. This could significantly simplify the financial obligations of miners and remove potential double taxation currently facing the digital asset industry. So that's all we have for this one. Make sure to like the video and subscribe for more content just like this. Till next time.